So as we all know by now as investors, 2022 was a crazy year, and in my personal portfolio I made some good gains and some bad losses as well, but overall we were able to squeeze out a profit even during the biggest market drop in 14 years. So if you want to see our total share price gains and losses and our passive income for 2022, feel free to check out these videos here on the channel. But in this video, we're going to give a breakdown about what happened in the last year, as well as go through the 5 ETFs that we're going to be looking at and investing in during 2023, and exactly the reasons why we think they are good ETFs to invest in. And by the end of the video, we'll be buying a couple of them live and in real time. So let's get started. That's better. Okay, so before we get to 2023, let's do a quick recap of 2022. There were 5 major events that happened which affected our markets, and those things were COVID, the war in Ukraine, high inflation, rising interest rates, cost of living increases, and a technical recession. Now, because of those 6 things, the S&P 500, which is often seen as the best market indicator, went down 19.4% in the year, making it the worst year for the market since 2008 and the 4th worst year since the index started 65 years ago. Simply put, many economies were still facing difficulties, supply chain delays, and inflation from the effects of the pandemic. Then in February, Russia invaded Ukraine and created a huge shortage of gas and energy, which used to come from Russia, but now with sanctions was no longer available, so energy prices soared on high demand and low supply. Those 2 events caused inflation to run away with itself, and CPI reached 8, 9, and even over 10% in some places in the world. As a knock-on effect to the highest inflation in 4 decades, the reserve banks worldwide started raising interest rates as a way to bring prices back under control. Basically, this creates pressure on households and reduces demand, so prices come down, so everyone would have to pay more on their loans, such as credit cards, cars, and home loans, and the final nail in the coffin was the cost of living increase. With basic goods being more expensive because of inflation, fuel costs rising due to Russia's war, and interest rates causing debt payments to go up, average everyday people have less money in their pocket to afford luxuries. So the companies that we invest in were selling less products to customers and had higher expenses due to higher energy and debt costs. Okay, I need to take a breath there, but in a nutshell, that is why your portfolio might have changed colors from green to red this year. But what does that mean for 2023, and is it even possible to make profits this year? The answer about the profits is yes, it is definitely possible. Even during last year, we were able to make profits on some of the investments because we used dollar cost averaging, which means buying smaller numbers of shares regularly or every month, even when markets were down, and make some profits when the markets came back up. It's not certain that this will happen in 2023, but there is also a bigger picture. Because investing is not always a short-term game, and sometimes we should be looking to hold the investments for at least 3 to 5 years. And looking at the history of the markets, it has only happened twice in 70 years that markets had 2 down years in a row. And yes, it could happen in 2023, but if you invest for a 3 to 5 year period, you have a very good chance of making a profit in the short to medium and even long term. And even better, if you invest when the markets are at their lowest, you have a great chance to make much higher than average gains in the times to come. Many analysts have recently said they predict that 2023 will be the last difficult year, and that during the year inflation and interest rates should reach their peak before both coming down either in the end part of 2023 or early 2024. And markets historically go up when interest rates go back down. So in saying all that, I will continue my strategy, which is to keep investing into the markets during the year, dollar cost averaging into market indexes and ETFs, and looking for good deals or special circumstances to buy into individual stocks. And with that strategy in mind, these are the 5 ETFs that I will definitely be looking at and buying into in 2023. We're going to start simple and easy and go more complex with each one. The first are simple. I will be investing into the major market indexes. Now, indexes are basically a combination of stocks that will represent a certain market in a part of the world. For me, I'll be looking at the S&P 500, which is the 500 largest companies in the USA, the JSE Top 40, the 40 largest companies in South Africa, and the FTSE 100, the 100 largest companies in the UK. These ETFs give you a diversified investment into the largest and best performing companies in each economy. Now, if you zoom out on all of their graphs, you can see that over the long term, they all go up and down, but it has a trend of going up and giving great returns. On a rolling 20-year average, none of these indexes have ever lost money in any 20-year period. So while the markets are down and depressed, I'll be buying into these monthly to buy at good, low prices so that when the markets recover, I can hopefully benefit from above average high returns. Then next up is Satrix Property Fund. This is a South African fund which accumulates some of the biggest and best property companies in the country into one ETF. South Africa has experienced a prolonged bad period for property, starting with an oversupply of buildings in 2015 to the immediate and lingering effects of COVID to what is now higher interest rates which will affect a portion of their loans and expenses. So much so that the property industry is showing some good value at the moment, and more importantly, some great dividends with this ETF at 8.2%. Based on the recent results published by the property companies, they have been steadily recovering with improved earnings, lowering vacancies, and many starting to return to pre-pandemic level dividends. As they recover and improve, the share price and dividends have been slowly doing the same, and I think the next 5 years will be good for this ETF. Then we have the Satrix FINI 15 ETF. As the name suggests, it's an ETF that tracks the 15 largest financial companies in South Africa, which are banks, life insurance, investment banking, and real estate investment trusts. The reason I like this ETF is because the finance industry is one of the few that benefit from interest rate hikes because many of them provide credit such as home loans, car loans, credit cards, etc. So as the interest rates go up, so does the income of the companies. Many banks this year have declared extra special dividends because of their higher income. Also, this is one of the few ETFs that went up in 2022 by 3.8% and is paying a pretty decent dividend of 4.08%. Now that is paid quarterly or every 3 months. I personally have some investments in the individual finance shares like banks and insurance companies, but this is a great way to buy into the entire industry and benefit from all the companies in it such as the 5 big banks, Investec, Sanlam, Discovery, and Old Mutual. Now, I want to chat a bit about passive income for a second. As we know, share prices are way down from 2022, but what is also good to know is that when share prices go down, the dividend income per share goes up. So if a company is paying 5% dividends at 100 Rand a share, if the share price drops to 50 Rand, the dividend percentage is now at 10%. So while prices are low, dividends are high. So it's a good time now to build your passive income with dividend ETFs. And the best and most reliable dividend ETF I know of is the Core Shares DivTrax ETF. It invests in the best dividend companies in South Africa, which have a track record of paying and increasing dividends year over year, also known as the S&P South Africa Dividends Aristocrats Index. Some of the companies in the ETF are Goldfields, Naspers, Anglo Platinum, and Vodacom, and right now the ETF is paying a dividend every 3 months of 6.9% a year. Then we move to the slightly riskier ones, and I'll tell you why I say that. The last ETF we're going to look at is the Vanguard S&P 500 Growth Fund. Now what exactly is that, why are we looking at it, and why do I say it's a bit riskier? So remember, the S&P 500 is the 500 largest US companies, while this fund focuses on the growth companies of those 500, basically meaning the companies which typically pay lower dividends but grow the most historically. Basically, it's your tech stocks like Apple, Microsoft, Amazon, Alphabet, Tesla, and Nvidia. Now in the past, these were the biggest growing companies over the last 10 years, but in 2022, they were the shares that dropped the most, with Apple dropping by 30%, Microsoft by 27%, Meta by 62%, and Amazon by 48%. The main reason for this was rising interest rates and inflation. Basically, they owe more on their debt, or customers don't have money to buy their products, or other companies don't have as much budget to advertise on their platforms. So, because they're at such a low base, some may say they could give the biggest returns. The problem or the risk is about timing the markets. Because although they went down last year, there is nothing to say they will go up this year. It is still possible that this ETF could continue to go down in 2023. So why am I recommending it? Well, regardless of market timing, these shares are trading at a very large discount to their value as companies, meaning you are buying shares basically on sale. And if and when they go back up, you probably stand a good chance to make some very large profits. The problem is when that will be. But if, like me, you are looking to invest for a minimum of 3 to 5 years and hopefully longer, then I think this is a very good long-term share that can return quite a bit. And lastly, just a quick shout out here to the Signia Fourth Industrial Revolution Fund. For similar reasons as the S&P 500 Growth, it is very heavy on tech and future-forward companies that will be struggling this year and maybe even in 2023 and the near future. It's down 31% this year, but it still also might show some good value in the long term as the operating environment for tech and engineering companies becomes more favorable when these conditions come to pass and when China opens back up and semiconductors become more easily available. And guys, that is it for today's video, where we show you the 5 or maybe 6 ETFs that we believe will be great buys in 2023 for short, medium, and long-term investing. We have already invested in the JSE Top 40, the FTSE 100, the S&P 500, the Statrix Property Fund, and we'll soon be adding the Vanguard S&P 500 Growth and adding to some of the finance shares we own. If you enjoyed the video and would like to see more market news and updates on our portfolio, feel free to like the video and subscribe to the channel to see more. But until then, I'll see you next time, as always, on Casual Cash. Cheers.